Hello, everyone. Tonight's financial literacy workshop is going to be using credit cards. I believe we have two sections to cover in this one. This one's not too long, so we may get done a little bit early. Um, and we'll have the participant guide available for anyone that needs it. Yeah, so in our first section, we're going to talk about how credit cards work. We're going to explain and define important like credit card terms, like key terms and stuff like that. And then choosing the credit card based on whatever your needs are, because we're all different. We all have different needs. Um, so knowing how credit cards work so you can more effectively shop around for one that meets your needs is going to be the key takeaway for the first one. But the first thing that we need to ask is what do we know about credit cards? Let's define some key terms first. A credit card is a revolving line of credit. That means that the balance goes up and down as you make purchases and make payments. Credit cards can be a convenient way to buy goods and services without using cash. And remember the difference between your credit card and your debit card. Your debit card is attached to your checking account, where the credit card is attached to that revolving line that we just defined. Um, so knowing the key differences between the two is that you can buy now on your credit card, but you're agreeing to pay later, where compared to your debit card, the money comes out of your checking account right away. There is a limit on how much that you can borrow on the card at one time, and that's called your credit limit. Sometimes it can be referred to as your credit line. The creditor will set it based on several different factors. One important one would be like your credit history. Credit cards require that you pay at least a portion of the bill every month, which is your billing cycle, and that's referred to as your minimum payment. It's usually a small portion. It represents usually about like 5% or less of the total amount that you owe. You can always pay more than the minimum, which is what I would recommend, especially because, and we're going to cover this in the second section when we talk about the truth in lending disclosure. Um, Depending on how big the interest rate is on your credit card, if you don't pay it off, you're going to end up owing a lot because the amount you owe will compound month to month if you don't pay the card off all at once. So with that said, I think it's important to remember that using a credit card is more of a financial tool than it is something that you would rely upon. Um, I would say more than like you would rely upon your checking account. So here's some important things to keep in mind. Paying your credit card bill regularly by the due date will build evidence that you have creditworthiness to your creditors. It can be a good strategy to either repair a credit score that's been damaged over time or just to build credit history and to create a healthy credit score. The creditor has to receive at least the minimum payment by the due date. It doesn't count as a one-time payment if you put your payment in the mail on the due date. But we'll talk about more about that in the next section. The opposite's also true though. If the creditor does not receive at least the minimum payment by the due date, that can damage your credit history and potentially decrease your credit score. A credit card can help you pay for emergency expenses when you cannot pay for them in cash. For example, you might need a car repair. You might need to buy a new refrigerator. You might need to fix a leaky roof. If you don't have an emergency fund to pull from, a credit card could potentially be that thing that bridges the gap between you not having the money now and you having it in the future for when you're going to make that credit card payment. Credit cards offer a convenient option for many types of purchases. Um, Another thing that they could be used in this sense would be using it for online purchases. You may not want to use your debit card on Amazon or eBay, for example, because that's directly tied to the cash that's in your account, whereas a credit card can offer more convenience to you to dispute erroneous charges that may not be yours, or just to dispute charges that result in a bad customer service experience with an online retailer, for example. Um, So you kind of open yourself up for the ability to, if you end up having any troubles with purchases. You may hear about other kinds of cards that are different from credit cards. There's charge cards. They're used like credit cards, but they don't involve credit. You have to pay the entire balance every month. There's also things like prepaid cards, or they're known as store value cards too. Essentially, with this, the way that these work is that money is loaded onto the cards in advance, and you can use the card to access that money when you want to make purchases. I kind of already scratched the surface a little bit on debit cards, but they don't involve credit at all. It's linked to your checking or your savings account. When you use them, the money is taken directly from the account that it's tied to. Some retailers may allow you to process a transaction using the debit card as debit or credit, and it simply refers to how the retailer processes the transaction. Choosing a credit transaction when you're using your debit card is not a credit transaction. It's just has to do with the way that it's being processed. Now, remember, I talked about that truth in lending disclosure. This is often referred to as TILA. Credit card rates and fees can vary greatly from card to card, so it's important to understand this key term when you're comparing credit card offers. So, the Federal Truth in Lending Act, or TILA, is a disclosure. It's a written disclosure that creditors must give prospective credit card customers. It contains important rate and fee information. The TILA disclosure is a helpful tool for comparing offers between credit cards. And it's important to read this disclosure so that you can understand the rates and fees associated to the card that you're signing up for. So let's add this to our key terms. APR, or annual percentage rate, is the cost of credit expressed as a yearly rate. It can include interest and other charges. The APR is a key term to look at when you're shopping around for a credit card. If you might keep a balance on your credit card, you're going to want the lowest APR that you can possibly get. If you expect to pay your card off in full each month, it may be important for you to compare between things like, hey, does this card have an annual fee attached to it? Hey, does this credit card have rewards uh, attached to it? But you may also use the card for unexpected expenses, so you may want to consider the APR in the long run as well, right? Credit cards likely have more than one APR. For example, credit cards can have a purchase APR for when you're purchasing things at a retailer, but it can also have an APR attached to balance transfers from other cards. And then you can also have the APR attached to it through cash advances. Using your credit card to get cash is another key term. That key term is cash advance. It's different than using your debit card at an ATM, for example, because remember, that debit card's attached to your checking account. With a cash advance from a credit card, you're borrowing the money from your creditor, and they typically always are going to have a much higher APR than the APR that a purchase would be on your credit card. So it's very, very important to read your cardholder agreement to understand what may be considered as a cash advance. For example, it likely includes using the credit card to get cash from an ATM, borrow against your credit limit using a convenience check or an access check. Sometimes you'll get these mailed to you, making a wire transfer or purchasing foreign currency. Let's add another key term to our belts here. Let's talk about penalty APR. The creditor will likely increase the rate of your credit card by a large amount if it does not receive at least the minimum payment by the due date. So you could be subject to a penalty APR. Let's add another key term to our list of terms for the night. Let's talk about interest rates. They could be fixed or variable. A fixed rate means that the interest rate will not change until the creditor tells you in writing that it's going to change. Variable rate means that the interest rate will likely change more frequently. Variable rates for credit cards are tied to another interest called the index. If the interest rate on the credit card is variable, it'll go up and down as the index goes up and down. Let's continue our key terms and talk about low introductory APRs. These are often referred to as teaser rates. and they're sometimes offered for a limited time to attract new customers. Creditors must clearly tell you how long these intro rates last. They can't impose new rates until the advertised period, which must be at least 6 months. It's very important to know when the teaser rate ends and when the new rate will be and how it'll be determined. If you have to, if you do not pay off the card in full before the teaser rate ends, be prepared to pay what could be a much higher interest rate on your existing balance in any future purchases. For example, a card might offer no interest on purchases for the first 15 months, but after that 15 months is over, the interest rate might be variable and could be anywhere between, say, 15.5 to 25.5%. It just depends. That's why you got to read the disclosure. Learning about credit card fees, this is something that you can check out in the participant guide after the workshop, but this kind of will help you understand and matching key terms and expanding upon definitions. This is what you would see. I don't think we have the next page. No, we don't. Before we go into rewards, let me give you an idea of what you would see in the participant guide for this. It's basically matching the fee type in the left-hand column to an answer key that would be on the right, which is what we don't have right here, but you can see in the participant guide. Let me give you an example of what this would look like. So you can see our fee type in the left is late fees. So the answer on the right-hand column would come from the answer key, and the answer key would be answer number 3, which is these fees are charged for not making payments on time. I'll give you another example. The next one in our key fee terms is annual fees. On the answer key, the answer would be number 4. This is a fee charged every year to use the card. The annual fee is a key term to look at when you're shopping for the credit card. If you have a good credit history, you can probably find a credit card without an annual fee. So yeah, check this out after the workshop, and you can match the key terms to the answer key that's there. Let's talk about rewards really quick. Some credit cards offer rewards, such as cash rebates on your purchases, points that can be used to purchase other goods or services, or airline miles, for example, that can be used to redeem airplane tickets, right? Know what you need to qualify for these rewards. For example, you might have to spend a certain amount on the card, and to be sure that you understand how much you would have to spend to accumulate enough points or miles to get exactly what it is that you want. Also understand that what you need to do to maintain these reward points. For example, they may expire if you don't use them within a set period of time. Think about whether the rewards will cause you to overspend. For example, if a card offers you a reward if you spend at least $2,000 within the first 90 days, were you really planning on spending that much in the first 90 days? So just make sure that the reward is a good fit for you and doesn't cause you to overspend. Consider the fees associated with the card when you look at the rewards. For example, a credit card might offer seemingly terrific rewards, but also charge high fees. This would be an example of like an American Express Platinum card, which could have upwards of an annual fee of like $500, but the rewards are good. You need to find that balancing act between, what is going to suit your needs and what kind of rewards you're looking for. And remember, shop around, cross compare cards, and see what would have the best rewards for you. Let's define some other important key terms. Uh, if you are approved for a credit card, the creditor will set a credit limit on that card. This is the maximum credit that you can use. Each creditor has its own standards for determining the credit limits. They may consider your credit history, your current income, or your outstanding debt in doing this. Let's talk about another key term, grace period. The grace period is the time between when your statement is issued and when your payments actually due. During the grace period, you'll not be charged interest on new purchases if you pay your balance in full, so the creditor receives it, by the due date. The law does not require creditors to provide a grace period. Some creditors might provide a grace period for purchases, but not for cash advances or balance transfers. If the creditor chooses to provide a grace period, the law requires the creditor to mail or deliver the credit card bill within at least 21 days. And delivery could be through an online statement as well. So that's important to remember. The balance computation method is how interest on your account is calculated. There's some different methods. You can find out which method a creditor uses by reviewing your credit card application before you apply. An example of average daily balance method is something that a creditor might use. So you add up the ending balance on your credit card account for each day in the period covered by the credit card statement. Divide that total by the total number of days in the period to get the average daily balance, and then calculate the interest you owe for the period based on that average daily balance. If you're comparing credit card offers that use different methods to calculate your balance, think of whether you'll want to be carrying a balance because you may want to pay it off every month. And if if you're going to be using your card by charging small amounts throughout the month, or if you're going to use the credit card just to make one large or very few purchases throughout the month. There's other features, products, and services that need to be considered as well. Um, Cards may offer different customer service features, such as the ability to make your payment online or through the app on your phone. Some creditors may give you the option to call a toll-free number. Some may give you the option to make your credit card payment inside of your local branch, your local bank branch, which is cool, or on the company's website as well. Some credit cards may offer you additional features for free. For example, the creditor may extend the warranty period on certain products you purchase using a card. I'm pretty sure I have that through the Chase credit card I have. I think I get like an extra year of a warranty on like a television purchase or some electronic purchase or something like that. Some may offer you to access your credit score for free. There may also be additional products and services that you can choose from. Things that could be offered through your credit card company could be payment protection or credit protection, which helps you make payments if a specific hardship occurs, such as unemployment or hospitalization. Know the costs and limitations of those too. That'll be in the terms of services. Programs that will monitor your credit report for signs that a crook may be attempting to use your name and commit fraud. Those are pretty cool. Credit monitoring things that could be offered to you at a very low fee through a credit card or maybe for free altogether. You never know. Additional products and services that may be offered are optional. Before agreeing to pay a fee for any additional services, make sure that you're checking out the um, disclosure prior so that you know how much these things cost. Um, in the participant guide, we have this scenario here with Siddharth where he's trying to decide what credit card is best for his situation. Uh, Go through this after the workshop so that you can see a scenario in which he's trying to decide what credit card is best. Here's some questions that uh, we're considering and the answers that we're considering that go hand in hand with the key terms and definitions that we've provided so far. What are things that Siddharth should consider in his credit card cross comparison? What card should he choose? Well, in his scenario here that you'll see is that his income varies. Um, and it's possible that he'll need to occasionally keep a balance on his credit card. So what's the possible answer that we would come up with a good card for him? We would want to consider a card with a low APR. He may also want to compare rewards offers and length of grace periods. I don't know if we have the comparison chart here, but I can, yeah, oh, we do have the comparison chart. So this is what you'll see in the participant guide. These are the things that we're considering between credit card one, credit card two, and credit card three. And essentially we can do use this chart for when we're cross comparing and shopping for credit cards for ourselves. You would fill this in based on the terms associated to each card and basically what fits your needs the best. And in this scenario, there is a card that fits Siddharth's needs, but check that in the participant guide. And you can always use this credit card comparison chart to better help you decide what credit card would be best for your situation. Um, Banks and other financial institutions offer both unsecured and secured cards with varying credit limits and rates. Until now, we've talked about unsecured credit cards, although people usually don't think of them in that term, really. With unsecured credit cards, the creditor lets you borrow money using the credit based on their expectation that you're going to pay back what you owe them. There's another type of credit card as well, though, called secured cards. A secured credit card requires collateral. You keep money as collateral in a dedicated deposit account at your financial institution that's issuing you the card. The card is secured with that collateral. So, for example, if you want a secured card with a $250 limit, you'd be required to deposit that $250 into a dedicated savings account that's attached to that through your financial institution that would allow you to use the card. The creditor would report your payments to one or more of the credit reporting agencies if you pay at least the minimum payment regularly so that the creditor receives it by the due date. You generally can use this as a good way to improve your credit history. Or if you don't qualify for a traditional unsecured credit card, this could be a great financial building tool to repair your credit, as long as that secure card is being reported to the credit bureaus. Secured credit cards typically have lower credit limits than unsecured cards. Some people apply for secured cards if they're unable to get the unsecured card. So yeah, you can definitely use this as a way to build your credit history, especially if you don't qualify for the unsecured card. Let's talk about applying for the card. So when you decide that you're ready to apply for a credit card, there's several different options to find credit card offers. For example, many financial institutions offer credit card products. You can call or visit your local branch and talk to the branch personnel at your local retail to see what they have to offer. You can also apply for credit cards online, and you can go to things like different uh, credit websites that can pull in different credit cards and cross compare the offers and in the things that you would need to appropriately shop for the card. Some websites may present credit card offers through different creditors. I think Credit Karma is one, NerdWallet, things like that, where it'll pull in like several different credit cards that you can use to fit your needs. You may also get credit card offers in the mail. I know I'm still getting them and it's ridiculous. You have the right to opt out of receiving certain mailed credit card offers. You can tell the credit reporting agencies not to share your information with creditors and insurers who use the information to decide whether to send you offers on credit or insurance. You can opt out on receiving these pre-screened offers by calling 1-885 opt out or by visiting opt-out-prescreen.com so that you can not receive these anymore. It's helpful to understand that some key terms in the credit process. Let's define some of these real quick. Credit card applicant, when you apply for a credit card, you are called the credit card applicant. Remember that providing false information about your income or any other information on your credit application is a crime. Anyone under the age of 21 who wants to obtain credit must have a qualified cosigner on the account. Creditor, this is the company that issues you the card, often referred to as also the credit card issuer. Individual credit, when you apply for a credit card on your own, you get individual credit based on your own assets, income, ability to pay, and credit history. You are the one that's responsible for paying the credit bill. There's also joint credit, though. When you apply for a credit card with another person, you get joint credit based on joint assets, income, and the ability to pay, and the credit history of both people. Um, Authorized user. An authorized user is someone who's allowed to use the credit. Um, you are legally responsible for paying all charges, interest, and fees that result from the authorized user's use of the card, though. So when you're if you have an authorized user on your account, make sure that it's a responsible person. So that brings us to the closing of our first section. Knowing how credit cards work can can help you effectively shop around to make sure that you're getting the right card for you. For our final section, section two, we're going to talk about managing your card. We're going to find key pieces of information on credit card statements, explain how different payment strategies affect the time needed to pay off credit cards and the cost of borrowing, and then list ways to manage a credit card effectively. So the key takeaway from our final section, credit cards can be convenient, but manage them carefully to keep costs down and avoid damage to your credit. Let's talk about reading a statement. If you have a credit card, you're going to receive a monthly bill either through the mail or online or both. Billing cycles are usually about a month. If you select paperless statements, you'll have to review your statement online. Let's talk about some key terms again. Account billing cycle is defined as the time period covered by the statement. Account summary includes your previous balance, the money you owed as shown on your last bill, new balance, what you owe now based on your previous balance plus any purchases, cash advances, late fees minus any payments and credits, credit limit, the maximum credit you can use, credit available, the credit remaining on your account after your new balance is subtracted from the credit limit, payment information including new balance, what you owe now, minimum payment due, the minimum dollar amount you must pay so that the creditor receives it by the due date on the statement, perhaps 3 or 4% of the new balance. Payment due date, the date your creditor must receive your payment, which is not the same as the date your payment is postmarked. Late payment warning, an explanation of what will happen if you don't make the payment on time. Minimum payment warning, a table that shows how long it'll take to pay off the new balance if you only pay the minimum due each month. And I really think that that table is probably one of the most important parts of the statement because even a small purchase like $50, if paid over 36 months, for example, at a 30% interest, can end up costing you so much money down the road. More items on credit card statements, credit counseling statement, how to obtain information about credit counseling services, notice of changes to your interest rate, which are changes in the interest rate, if any, transactions or account activity, including transactions made on the card, finance charges, which can include interest, service charges, and transaction fees for the account billing cycle, annual fee and interest totals, which are the amount you've paid in fees and interest during the calendar period, and interest charge calculation, which is how the interest charge was calculated on your credit card. In the try it section in the participant guide, you can find items in the credit card statement. This is kind of a scavenger hunt within an example credit card statement. I don't know if we have the picture of the example. We don't. So in this try it section, there's going to be an example credit card statement. And in there, it's going to have all those key terms that we just defined: previous balance, payments and other charges, purchases and adjustments, any balance transfers, fees charged, the late payment warning, so on and so forth. And that's going to be in an example statement. And essentially, you're going to scavenger hunt through that so that you can match the uh, key terms with the answer. Allow me to give you an example. We can see the first one here. What is the credit limit? And in that example credit card statement, you're going to have a dollar amount. So the answer, because we can't see the example here, is $2,000. And the answer says that it's also referred to as the credit line. Question number two, what is the minimum payment due and when is it due? You would pull this from the sample statement, and the answer would be $20 by April 21st, 2020. So uh, go through this in the participant guide. Um, Go ahead and answer the questions based on that sample credit statement. And this will give you a better idea for when you're ready to review your own credit statement, where you can find those key terms and dollar amounts and dates and things like that. Steps for managing your card. Credit card debt can accumulate so quickly. That's again why I think it's very important for you to check out the table on your credit card statement. If you don't pay your balance in full each month, and hey, if you're subject to late payments because you haven't paid, it could result in fees and higher APR. These things can add up quickly. So to start, it's good to keep good records. So keep your credit card receipts, compare them to your monthly statements. Some people prefer taking pictures of the receipts or scanning them into your computer. I don't care how you do this, but it's very important to keep them so that you can cross compare to your statement. Check your monthly statement for any mistakes. Because if you find a mistake and someone took advantage of you and put fraud on your card, then you don't owe that. So it's important to check it because you have to report a mistake to the creditor within 60 days of it being on the statement. Pay your credit card bill on time and pay at least the minimum amount due each month so the creditor receives it by the payment date. If you don't, you could be subject to late fees and additional interest. Late payments and payments of less than a minimum amount due can significantly affect your credit history and reduce your credit score. And remember, postmarks don't count, right? So when it's due by the due date, that doesn't mean that it's postmarked by then if you're paying it in the mail. One way to skirt around this, though, just pay it online or on the app on your phone. Try to limit how much you owe compared to the credit limit. So I'm going to throw another key term at you, which is credit utilization. This is an important key term. Credit scores are generally higher for consumers who do not max out or otherwise use a large share of their available credit. The percentage of your credit limit that you use is called the credit utilization rate. Using a large share of your credit limit at any point in the month may have a negative impact on your credit score, even if you consistently pay your credit bill in full that month. Some experts advise using no more than 30% of your credit limit, while others advise not using any more than 20%. While keeping balances at or below those percentages may not always be realistic, it helps you use as little of the credit limit as possible, thus giving you a healthy credit utilization rate. Understand the impact of different payment strategies too, including paying only the minimum payment or paying more than the minimum payment but less than the full balance, or paying the full balance by the due date. Let's take a look specifically at some different payment strategies. So let's see what this table looks like. Paying only the minimum payment. So in the table, compare the price of items with how much you pay when you only make the minimum payment. This payment strategy can result in many years of payments and you paying a lot of interest rather, sorry. If you paid for these amounts in cash, you obviously wouldn't owe the amount. So you can see we have a TV, a repair, and furniture. You can see that you paid $500 for the TV at an 18% credit card interest. You're paying $132. Um, a $1,000 repair at 18% would be 863. And then furniture for 2,500 would be 5363. Now that's just the interest. Look at the total amount that you're actually paying, which is in the fourth column. And then the total amount of years it would take for you to pay off if you only paid the minimum amount. So let's look at the furniture. Your furniture only costs 2,500, but with an 18% APR, you're paying $5,363 on that. So the total amount with interest is $7,863. It would take you a total of 23 years to pay it off if you paid the minimum. That's crazy, right? Paying more than the minimum payment. So this gives you an idea of that $2,500 balance at an 18% rate. Only paying the minimum payment would be 23 years, but look what happens on the next row. 2,500 with the minimum payment plus an additional $24. It only takes 4 years to pay off, and look at the amount of money you're saving. If you only paid the minimum in the first row, it would be $7,863. But by adding an extra $24 with the minimum payment, you're only paying $3,525. And instead of it taking 23 years to pay off, it's only taking 4 years to pay off. Now look at what happens if you add an additional $41 to that payment. You cut a year off of the second row. It's only taking you 3 years to pay it off. And now it's only $3,254 for that total payment. So you can see that the different ways that you can handle the payment, if you make the minimum payment and add a little bit more to it, you can significantly not only reduce the total years that it would cost to pay off the total amount, but you can see how much money that you're saving in interest. I mean, it's incredible what the length of time is on these things and how much you can save. Um, and it just depends on how you want how much you want to pay essentially. The minimum payment way um, may be the way you have to do because you don't have the cash in the bank. Um, but amounts over the minimum would be my suggested way if you're able to swing it. So in this apply it section in the participant guide, which you can check out after the workshop, you can use these tips to manage your credit card more effectively. And you check the tips from the list you want to start to use. So let's talk about this really quick. So we can see here that some of the tips we have, review your monthly statement as soon as you receive it. And remember, like we said, contact the credit card company right away if you notice any errors. Another tip, pay off your balance each and every month so that you can save and avoid those interests. And you can see by looking at the table, you know, the benefit of paying it off so that you're not subject to the interest rolling each month. Remember, we talked about that credit utilization. Try to minimize how much you owe in relation to the credit limit. Remember, the industry experts want you to be between 20 or 30%. Keep a record of important information about your credit card. It includes credit card numbers, expiration dates, website addresses, telephone numbers, maybe the branch manager's name if you know if you can go to a local branch. Carry only the credit cards that you expect to use. If you have multiple credit cards, lock up or cut up the ones that you don't use. Read the rules that govern the credit card. Remember, it's very, very important. You're looking at that cardholder agreement so that you know all the terms and conditions of your credit card. Read all the notices and information that you receive from your creditor so that you can stay on top of anything that changes. And there's some other things in there, but please check that out after the workshop. I think this brings us to our close. So remember the key takeaway from section 2 in our closing. Credit cards are convenient, but we want to use them as financial tools. And the only way to do so is managing them carefully because you can see how crazy the cost can get if you're doing that minimum payment method. It can really snowball and get out of hand really quick if you're not paying the payments off right away. Um, but yeah, so credit cards, financial tool, but you can get into trouble. And I think I can speak for everyone. Um, I got into trouble in my early years, in my 20s, when I got my first credit card. I got my first credit card when I was in high school. Shockingly, I got a Capital One credit card with a $300 credit limit. And guess what happened when I got that card? I spent $300. That was
Wait,
not me using my credit utilization right because I spent 100% of my credit limit. Um,
$300 was your credit limit though?
$300 in high school, and I spent every penny of it immediately.
Yeah.
And it wasn't
My
good. I had a bad credit score because I was irresponsible. Um, One of the other things too I forgot to mention in the workshop was if you get into trouble like I got into trouble back then, don't forget, rely on credit counseling agencies. So nonprofit agencies are there to help you. Um, and nonprofits like Home Again LA are here for like financial literacy workshops like this that you can get information on. But there's also nonprofits out there that actually can help you repair your credit that don't charge you. So just Google search um, credit agency in my neighborhood, nonprofit, thing like that. So in case you need help, um, you can not only it can help you get out of the debt that you've created, but maybe repair your credit score, get your credit history back online. Um, Credit card consolidation they might be able to help you with, which could help you lower your interest rate, but use those tools at your disposal too.
Absolutely. Alrighty. Thank you, Tom. We appreciate you, and we'll catch you in a few weeks.
All
Or actually,
right.
next week, next Wednesday,
Yeah. So next week and then the week
week
after.
after.
Yeah. So
So the
lots of
11th and
workshops
the
this week.
25th.
Yeah.
Yeah. All right, Tom.
All
Thank you so
right.
much.
Bye,
Have a good
Lisa.
day. Bye.